How are we all doing? Happy Thursday morning. Wet hair Thursday. Just got back from the gym. Morning, Novelty. Christian, Pot Guider. Ian, Outro, Evans, Virginia, JC, Danny, Gregors, Mumo, Mark. How are we doing? So just a quick recap of yesterday. Nice profit yesterday across the US indices. If you weren't here yesterday afternoon, all trades worked out. Where's my pen? So we got hedged on the NASDAQ yesterday at the pre-market open. Got out the longs at target. Aggressive exit on the pullback. So that was a nice, easy, well, it wasn't easy because it was a hedge, but it was an as expected move. Dow, really quick, easy break. So the pre-market range just went, actually, that's not the pre-market range. That was the pre-market range. Shot straight up to target, got out the second on the pullback. So that was nice and clean. S&P was clean break, but took forever, didn't get to target, pulled back, sat around for 20 minutes, pushed up, sat around for 25 minutes or so, pulled down, sat around for about an hour, then finally pushed up. So I took that off there at that high, expecting it to pull back down again, and that's when it ran. So it missed my target. You see my target is there. I don't know if you can see that, but that little blue line is my target. That is where we stopped at yesterday's high. So it missed the 5R target literally by 2 pips, and then it pulled back down, so I got out. So good day yesterday on the US. Yesterday morning on the DAX and the FTSE, I got hedged. I didn't realize, but my terminal, I wasn't paying any attention. My terminal froze yesterday, so I didn't manage to get out of the trades. So they were held this morning. I opened the terminal this morning and I still had live trades on. So I've actually banked this morning on yesterday's trades. I took a loss on yesterday's trades on the shorts, but the longs didn't exit, as you can see. I don't know if you can see that. So I don't think this EA is going to trade this morning. So I got out the shorts there, waiting for a pullback. And for some reason, the terminal just didn't do anything. It was not responding, basically. My other terminals were working fine, but this one froze. So it was my fault because I didn't pay attention. But it's a happy accident because it's basically got back the loss from yesterday. So I got out that this morning when I opened the terminal up and saw it. And the same there. So I've got out of a break even on that with a loss there yesterday. So I don't think the EA is going to trade today because one of the rules in the logic is if we've made a profit, we don't trade. And the EA has made a profit. So we'll see what happens this morning. That one hasn't, but that one has. And it's made a loss, actually. So, yeah, maybe it will. It's an experiment this morning. See what happens. So it's CPI day. We've got 5 minutes to the open. CPI day today, which means we've got market movement an hour before the US Open this afternoon. So you need to be aware of that, obviously. The market, when we're waiting for a big number, tends to sit in rotation for the morning because nobody wants to put any money in or pull any money out of the US until we know what the CPI is and whether or not that's going to cause a quick flurry or drop in the dollar, because obviously a lot of transactions, most of the transactions happen in the dollar. So we'll probably find a rotation this morning. The indices for the European markets shouldn't really be affected by that because it's not traded in dollars, it's traded in euros and pounds, but the US indices will be. So if we've had a very big, strong move and we've got ADR hits on the US indices this afternoon, quite often you just get a rotation because all the money has been dumped pre-market open. So we'll play it by ear this afternoon and see what's happened. If we get the CPI number and it's a massive whipsaw, probably be okay. But we don't know what's going to happen with these numbers. So that's your main news today. We've got the unemployment claims released at the same time. So that's 1:30 this afternoon. Other than that, no more news. Overnight news, there wasn't anything I could see of any interest. Bank of Japan was talking overnight, but nothing exciting in there at all. Nothing that would give you any indication as to bullish or bearish sentiment moving forward for the yen, or any changes in interest rates, which is what we're interested in. So yeah, there's your news overnight. Nothing exciting. So far today, wrong terminal, right terminal. Now I've got way too many terminals open. Come back. So far today, no ADRs. We haven't hit anything on the weeklies, and we are no monthlies, obviously, as we know, because the market's not going anywhere. So we've not hit monthly levels, but nothing's hit this week, and we've got no ADRs. We had some ADRs yesterday, so I got into some positions yesterday. We had some RSI extensions yesterday as well. There was quite a few RSI extensions yesterday. It was all yen based. So everything yen, as you can see, lit up like a Christmas tree because we've had that weakness in the yen. So it's all yen extensions at the moment. So short on euro yen. This is the 3 minutes to go still. This is the H1M5 mean reversion. So I've got shorts on US yen, pound yen, euro yen, and Aussie yen. All shorts, waiting for pullbacks on these moves, mean reversions. Need to put targets on this. Euro yen. What is it? Mind you, I've got to get used to this new account size. I will go middle of that range there. So an ADR hit to the downside should really target that propulsion gap. I'm going to go for that propulsion gap down there. We'll see what happens. So that's euro yen, pound yen already in. So now in 4 on the pound yen. So TPs, I'm going to adjust down to that low. So top of that propulsion gap. I think I've got a TP on that. So yeah, so TP 150 ADR down there. So basically retested the low of that accumulation, top of that propulsion. Euro yen, pound yen, US yen, 3 on now. So retargeting. Just because I've got so much yen exposure on, I might just go for that propulsion gap. And just get out of some of this if we do get a push down. Aussie yen, just one position on at the moment. So first entry, that's a nice easy target, that propulsion. And then euro pound, which is basically second position taken on that one a couple of days ago. This thing's just totally stuck. So I'm going to stick with the propulsion target to the upside. There we go. Didn't manage to bank yesterday because yen pushed, nothing moved. 1 minute to the open. So let's just see what we do with the EA today. I'm not sure what's going to happen today because of these trades. Oh yeah, we are trading. So we're trading the DAX. So we're trading both. That's fine. Good. Okay. Yeah, because there's nothing banked there, and the that's a loss. So fine. Short on the DAX and short on the FTSE. So short both today. So yesterday, FTSE, we basically had a down day. DAX, we had an up day. So divergence across the two yesterday. Nice break short on the DAX. Watch this high, which is exactly where we're tapping into now. As you can see, to the pip, yesterday's high, straight off of it. Limit orders triggering for all the people that bought yesterday, wanting to buy again. So watch this propulsion gap for support to the downside. We've got a bit of a gap here to fill. So there is a gap fill opportunity on the DAX to the downside. So hopefully they'll run down, fill that gap, and then they can do what they like from there. Obviously, targets to the downside are going to be this weekly low. So this area down here on the DAX is where we've been playing around for a bit now. So we pushed up into this area a couple of times, retested it, then we finally broke through it, came down, bounced and tested it. So this weekly low, which is ADR today, which is yesterday's low and the previous day's low and these previous highs, That's your obvious downside target today. If we're going to have a down day, we're going to find resistance there. Support rather. FTSE, you're looking at yesterday's low and that weekly low from last week as well. But the market seems to be rejecting yesterday's high at the moment. And this pre-market area, which isn't really a pre-market area. So we've got gaps to fill on the FTSE and we've got gaps to fill on the DAX. So there is a downside gap target today, which would be good if we can rally straight down to there, but we'll see. Morning, everybody else. I haven't said morning to. Where did I get to, Mark? What time do you go to the gym in the mornings? 6:45. My spin class. It's only on a Thursday. I spin every day, but I do one in the Thursday morning and I do one Thursday afternoon as well. Why has the DAX crept up overnight? Just been scap up, basically. Going to get hedged on the FTSE by the looks of things. These European indices are not being very friendly at the moment at the open. Tough week this week. Yeah, but it's just stock prices have opened higher than they were at yesterday's close, basically. That's all. The spread on the FTSE is really big. I don't like the FTSE. Hedged. Nice easy hedge to the upside. So 125 ADR to the upside is the hedge target long. Or this area here. So we got this area which has been respected so much there, but over and over again, which is this propulsion gap out of this accumulation from when Tuesday. So that propulsion gap is within ADR, and that's a previous weekly low from the week between Christmas. So that's quite close and achievable as well. I might go for that today. So I'm going to target this middle of this propulsion gap, which is within ADR to the upside. Downside, easy, yesterday's low. So just going straight for yesterday's low. We've got the gap as well. So we'll see what happens. We might just get that gap tested and then filled and come back up from there. But I'm not expecting a big day today because we've got the CPI figures. But we'll see where we go. At the moment, the market just seems to have tapped straight into yesterday's high and just rejected. So. Morning, day trader, Peter. Baggy, Rajiv, Thimba. Currently short on the pound US dollar. Good short, yeah. Nice resistance there. Good looking short opportunity. Morning, Monkey. Morning, Neo. Kennelly. Can you please show your settings for the UK 100 SAH? Screenshot. Got it? Oh, you are kidding me. Look at that. Didn't even hit my entry level. Just got taken in with a spread. Now it's going to collapse, isn't it? And go and do the gap fill. Okay, so there's your 5-minute opening range for the DAX. So it's a fairly decent size today. 308. That's within 20% of ADR, so that's a valid trade. If you didn't take the pre-market and you want to take the 5-minute ORB, that's valid today. Same, actually, the FTSE might be a bit big. 140, yeah, that's too big. That's over 20%. So the FTSE has done over 20% of its average daily range within that first initial cash balance candle. So you'll find it hard to get an R, a risk reward off of that. That's going to give you 2R, which is ideally what you want. So that's not valid, but the pre-market was. Little bit lackluster in it at the open. Let's have a look at Forex while we're waiting for this to decide what the hell it's doing. So, yeah, nothing banked yesterday. Slow month this month. Nothing I can do about it. Market's not really moving. Yeah, in positions, which is good. Got some risk on now, which is nice. So just waiting, really waiting for some yen strength to come through, which is my main focus at the moment, getting that yen moving. Obviously got those 4 exposures on the yen at the moment. US dollar yen shorts. Obviously CPI today. We could be down here. We could also be way up there. So we'll see what happens with the CPI figures. But I'm hoping for negative moves on the US today. I'm hoping that CPI figure drops or comes out as forecast, because that will encourage the US to drop interest rates, which is going to devalue the US dollar. So I'm hoping for as expected or lower than expected numbers today. That will also help the yen as well. When the US tends to drop, we tend to get a little bit of strength coming through in the yen. As money's moved out of the US dollar, it gets moved into safe havens while people are thinking where to put it. So you get power in the Swiss franc, you get power in the yen. So obviously the perfect storm in that situation is if you're pulling out of the US and you're putting it into the yen, is a massive drop on US yen. So fingers crossed for short news today. All these yens, we're in a sort of 2.5 day extension at the moment. We've had a nice big rally yesterday. So we're due a pullback, so equivalent to that. So we were either going to flag and accumulate, or we're going to start a profit take move, because we haven't profit taken that move at all yet. And now we've got a second leg in. So we may well put another leg into the upside. If we do, we do. That's fine. Not a problem. We'll just wait. And we'll be getting a additional entry somewhere up at ADR in this accumulation. And then we'll look for a pullback on that move there. Euro yen, as I said, same thing. First entry on that one, looking for a nice, quick, easy pullback. But we've got all this accumulation here, which we slammed out of. So that is your resistance, which is 125 ADR today. So second entry there and a pullback if that happens, if it's needed. Aussie dollar yen, same thing pretty much. They're all the same. So we are out of this high now. So we'll see if the power they needed to get out of that high has exhausted the market, and we're going to get a pullback before we rally up. But we've got 2 very nice, strong monthly levels. So that's December's high, that's November's high. So we got both within 150 ADR today. So if we do get another good strong rally and weakness on the yen, there's a good chance we're going to hit some monthly players who are going to set limit orders to go short at those monthly highs, which will obviously give us a good kick down. And the euro pounders are covered. Not really doing anything at all. Just sitting sideways on that thing. It's not going anywhere. So that's the H1M5s. ADR reversals took 3 positions yesterday. Didn't manage to get on the euro yen yesterday. Didn't get a reversal alert yesterday on the euro yen. Just went parabolic. And then we went into the next day, and then we got the reversal alert. But obviously, this is a new day. There is no ADR today, so there is no entry. Didn't manage to get in that. But yeah, big strong push. So yesterday took pound yen, ADR reversal there. There was a reversal alert yesterday on that one here. So that was your reversal alert yesterday off of that candle there. So that was your break. So first short on that, so far gone nowhere today. Aussie dollar, New Zealand dollar, that was obviously 150 extension yesterday. I think it was 150. 695, yeah, 70 off of 40. So yeah, that's 150. So entry on that one yesterday. I've got 2 trades very close together there. That's because of, you can see where this trade has triggered. This is the problem with spread on the New Zealand dollar. I thought I had this set not to trade. I haven't put the time filters on this, have I? Yeah. I can never find settings in my own thing. It's too many. Where's the time settings gone? My God, can't even find my own settings. Oh, they are. Yeah, false. I'll leave it for the minute. So basically, obviously, this entry here, yeah, is way too close to that entry. It should be 3/4 of an ADR apart. This is a spread entry. So the market opened. The bid price was 3/4 of an ADR away. The ask price wasn't. That was the spread overnight on this. So you get this every now and again, and it's often on the New Zealand dollar pairs where it only happens on shorts, where you just get a bit too close. So it's a happy accident because obviously the trades are playing out at the moment. So what I'm going to do is on that second entry, I'm just going to break even the position. Just because it's obviously double exposure. So target on both of these. Really annoying, it's on a black line. I'm going to leave down there at these lows. So yeah, it's a happy accident. Got two positions too close together, both in profit. If this thing continues to tank, I'm not shutting it because I've got too close together. I've got a double profit, which is great. So, but I will break even that. So if it rallies against me, I do not want to go into double exposure into drawdown. So I'll take the profit if it gives it to me. If it doesn't give it to me, I will close out that second. And pound yen was the other ADR reversal from yesterday. Or was it the Aussie yen? Can't remember which one I covered. One or the other. Yeah, so the Aussie yen was the other one. So that's the one that's just broken out of those highs. So we'll see if this is a false breakout. If it is, we're pushing back down again. Target. I'll take target in propulsion, top of propulsion. Oh, I've got to get my head around because I'm trading 3 different accounts with 3 different balances. This is 30k, isn't it? Yeah. That's fine. Right, so that's ADR reversals. It's just going to take me a while to get used to this. I'm not used to trading 3 accounts with 3 strategies. I'm used to trading 1 account with 1 strategy with high volume. So I've got to get my head around different account balances, which is not normal. Hedging, 5 positions taken yesterday. We had 5 reversal alerts. I got hedged already on the New Zealand dollar CAD. So New Zealand dollar CAD, it's been going sideways. Therefore, we have no directional bias. Therefore, we've had a reversal alert short. We've also had a reversal alert long, as you can see. So 2 entries on that one, hedged, and we will get out when one gets somewhere. New Zealand dollar CAD long. Let's have a look at the highs up there. See if we can get out up at those highs and get a bounce up there somewhere. The rest of them, leave it, see where it goes. Right, that was yesterday. Hedged on the DAX as well. Cheers, guys. Good morning. We're one of those days today. I can feel it. I can feel it. CPI day. It's always a little bit quiet and sideways. Considering this week is quiet and sideways, unless you're trading the yen, when you got big news, this thing's not really going to be interested in going anywhere, is it? I was hoping the UK markets and the German markets wouldn't be affected, but it appears they are. So that I've set the UK 100 up, the FTSE. So propulsion target to the upside within ADR, propulsion previous day's low to the downside, which is well within ADR. Those are my upside downside targets there for the morning. That's really hard upside. What do you do with that? It's not getting to 125 ADR to 150 ADR on a CPI day. So that's not a propulsion gap. That is just a news event. So there is no target to the upside. I'm just going to leave that as it is at 5R and see if we get a push to ADR. That's really all you can do with that today. Is just there's nothing. There's no levels to look at. Downside. Downside support is potentially here. That line's thin, isn't it? So your downside support, we've got this little area sort of somewhere around here where we keep butting into, price keeps butting into it. It's not a specific level, but it's an area we keep sort of reacting at. We've had a reaction, we've had a reaction, we've had a reaction, we've had a reaction, reaction. Yeah, reacted again there, kind of reacted there, yeah? So it's just an area which we keep kind of tapping into, which is 167.15 roughly. So somewhere around there, which is that tiny little propulsion gap, might get a reaction. But other than that, DAX is really hard today. It's really hard to pick a level. I think I'm just going to leave it at 5R. That was ridiculous. There's absolutely no reason why it would react there. I'm moving down ever so slightly, just down to 166.71, which is basically yesterday we rallied up at the open, and then we came back and we tested this level, which is here, this little level here. So yesterday we pushed up, we came back, we tested this level, we pushed away, we rallied against it. Yeah, we pushed back down, we tested it again. We tried to push long, couldn't. Tried to push long, couldn't. Tried to push long, couldn't. Came back down through that level again and pushed away. So this yesterday was a strong reaction point, which was here and here. So there's in the last 2 days, that 166.70 level has been multiple times. It's been tested, and we've had a reaction. So we know there's bank activity there. If it breaks down and it hits that level, I think that's the only thing I can see apart from getting to ADR today, and I don't think we'll get to ADR. In fact, I don't even think we're going to get that far on a CPI day. Apart from getting to there, that's the only thing I can see to the downside. So DAX is virtually impossible today. Nothing's moving, so it's a hedge. Nothing we can do. Right. Morning, Yotko. Don't like the spread on the UK this morning. No, it's very big this morning. It's bigger than... That seems bigger than normal for some reason this morning, the FTSE. I don't know. I know the FTSE is a bigger spread, but that does seem quite a lot bigger this morning. Need to keep an eye on this, basically. Darwin X have got some of the tightest spreads out there. So this is one of the reasons I initially gravitated towards Darwin X. They are an incredibly good broker, very fast execution, and good tight spreads, decent commissions. They're just a really, really good, solid broker. Been around a long time. But they fly under the radar. They don't do a lot of marketing. They've got a lot of big investors, so they don't need to, really, I don't think. But yeah, that seems incredibly large today, but that is probably because of light liquidity. If you've got light volume, you get higher spreads because the market has to spread wider to find orders to get filled. So that's what spread is. So it might just be because we've got light liquidity today. A lot of wicks. Look, there's not a lot of movement happening, is there? So we'll leave them. If we get to those targets by CPI, great. If we don't, it's a lost day today. There's nothing I can do with it. Tough week this week. Really tough. I'm up 6.5% on the month, which is fine. I'm up. I think I'm up 6 to 9% on the US as well. So month's going okay, but just this week's just tough, isn't it? Can't seem to get a break this week. Not clean anyway. Trying to open another terminal. I've got 5 terminals open now, so my machine's going, are you sure? I know I'm up 3% on the US this month. So I'm up 9, just shy of 10% so far for the month. So on for a 20% month. We'll see. Right. That's all I've got for you today. This is just a whitewash at the moment this morning. We'll see if we get some volume for the rest of the morning. If we do, great. If we don't, fine. There's no RSIs. There's no ADRs. Apart from the yens, we've looked at them all. That's all we've got at the moment. The only thing moving at the moment is the yen, and it's negative. So there's nothing much else to look at because there isn't anything moving. We are literally sideways on everything. So it's resistance highs, support lows. If you get to them, take, like whoever it was said this morning, pound US dollar, good short. Resistance, it's not extended, but it is a resistance. We've reacted there 1, 2, 3.5, 4, 5, 6. Yeah, they are selling this level. Yeah, they may well. The chances of that happening or that happening are 50-50. But for the last 7 times we got to this price point, they sold it. Take it. If it doesn't work, short it there and get out when they short the profit on that move. So that's all you can really look for at the moment is support and resistance. Nice support and resistance there, whatever that was. CAD yen. Double top. Reversal alert's just gone in, although we are in accumulation. If we break that low, we should be coming down to retest one of those propulsions. Yeah. Not a lot to look at, is there, at the moment? If anybody's got anything I want to look at, let me know. Other than that, I haven't really got anything else this morning because it's dead as a door now. For the ADR scale-ins, this is for trades that go your way. No. Don't scale into trades that go my way. This is position trading, Mumo. You've been in here a long time, Mumo. I am a position trader. I trade market structure and I position trade it. I have done for many, 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 many years. I've been doing it live in here for nearly 3 years. And before that, I was doing it live on Zoom. I have never done anything different. I add to my positions that go against me, waiting for the market to pull back. I do not scale into positions that go my way. I get out of them because they've gone my way, so I take them. I can't believe you've just asked that question. Or am I misunderstanding the question? I don't know. It's like you've been sitting here watching me every day, but not paying any attention to what I'm doing. Didn't I see half an ADR between orders? Yeah, it's half an ADR. So the ADRs and hedging is half an ADR. 3/4 of an ADR on H1M5. Is the time issue relevant with H1M5 too, or is it just an ADR reversals issue? What issue? Is the time issue relevant with H1M5, or is it just an ADR reversals issue? I don't know what you mean. Don't understand the question. Morning, Amy. That H1 hedging, New Zealand dollar CAD, has that taken those trades without RSI extension? Yeah, it doesn't use RSI extension. The H1 hedging strategy literally takes every single reversal alert. If there's a reversal alert, it trades it. It literally just gets in the market. It's flip a coin. We've had a break in structure south. Looks like the sellers are in control. Short it. If they stay in control, take the money. If they don't stay in control and the buyers take control, go with the buyers. Wait for one of them to move to a level, take some money off, and then wait. Literally, that's it. It's the simplest possible strategy you can get. If reversal alert triggers, take it. That's it. There are no rules. We're not waiting for RSI extensions. If we were waiting for RSI extensions, it would be an RSI strategy, wouldn't it? Literally, hedging is getting in and scaling with the moves that don't work. So what the idea with this New Zealand dollar CAD is, it's going to either go that way or it's going to go that way. If it goes that way, we'll get out somewhere down here. And then when it pushes back up and has another reverse alert, we add another long position, move our average down, and we get out of the long. So it's hedging and position trading. It's basically the same thing. It's exactly what was running before for the last year on the VPS. I kept looking at every now and again. It was a test. It was a test strategy because I back tested it and it worked really, really well. So it's basically all this is a variation on what I teach in the bootcamp. What I teach in the bootcamp is a multi-time frame strategy. So it is waiting for RSI extensions. No, it's not. Yes, it is. No, it's not. Sorry. It's so it needs an RSI extension, doesn't it, to take the entry? But it trades on M5. So all this is a slower version of that strategy, basically. It's basically, I kind of call it the dumb strategy. It's stupid. It's like, hey, look, the market's gone down. Hit the short button. Oh, look, it's gone up. Hit the long button. Wait, one of them's going to work. We're going to bank some money. This is the beauty of this strategy. It is banking all the time, constantly, 20, 25, 30% a month, just constantly chucking money in the pot. But it's always, always, always in massive drawdown, because when you're right, you are also wrong. So as soon as you get out your rights, your drawdown goes, because all you've got is losers. So you bank loads, but your drawdown's always high. That's the downside to the strategy. But it makes money, lots of money. More money than all the other strategies, which is why I've decided to go live with it. It's maybe the worst decision I've made in the last 5 years. We will find out in the next few months. I'm on Tickmill, and UK spreads look similar to yours. Too big. Yeah, so the market's just light liquidity today. You can tell by the way it's moving. It's slow, and the movements are big. Yeah, every tick is like, it's not a tick. It's moving up 2 or 3 ticks at a time. It's trying to find liquidity. So the spread, if you look at a ladder on the exchange at the exchange now, you'll see there'll be bids up there, asks down there, and there's normally bids and asks there, but the asks will be 2 ticks down. So when these guys want to fill the order, they have to jump down 2 ticks rather than 1, because there's just not enough players in the market. So you tend to spread wider. You see it very clearly on a ladder. So you see, this is why we get these long wicks. So someone said, right, we need this long order filled. And they've gone, well, there's no one looking to sell to us here, so we'll take that guy's order. And then they go, well, there's no one looking to sell to us here. And they go, we'll take that guy's order. So what they do is they fill the order, and then everybody that's taken the other side of that order, as soon as they filled that order, there is no more buyers, because there wasn't anybody looking to buy. So it just drops straight back down to where it was. This is why you get long wicks. You can tell that it's light liquidity. Yeah, this means there's no volume in the market. Look at where we've gone. Yeah, we pushed up to there. That's where we are now. But look how much activity there's been. There's been loads of buying and selling, but there hasn't been any movement on price. So it's basically just people trying to get their orders filled, and they're just going, well, I'll take that one up there, and I'll take that one down there. Because normally I'll take his. And this is why you see it going like that. Price moves like that in high volume, which is what you see in the NASDAQ, because the NASDAQ is the highest volume index there is. This is just rubbish. It might move. We need them to get going. They're just not getting going. So it's one of the mornings to do something else. Was just double checking the meaning of the labels you put on. Oh, right. Yeah. So these, so the scale in is position. Yeah, scaling into trades as they push against, not when they go. But you said 3/4 of an ADR, 3/4 of an ADR on ADR when you've been looking for that Aussie New Zealand. So that was just, you said 3/4, but meant half. Did I? Sorry, I don't know. Yeah, that's because that's just me programmed into my brain, being brainwashed. I always scale in 3/4 of an ADR apart on H1M5, but the ADR strategy and the hedging strategy have always used half an ADR because with ADR, you are looking for a quick exit. So when you get an ADR move like that, you will always get some kind of pullback off of it. Yeah, you'll always get some kind of pullback. So if you're getting in there and you scale in half an ADR apart, you can get out on that pullback. So it's a scalping strategy, really. But what you're looking for is those scalps to work quickly within a day or two. If they don't, they turn into normal position trades. So getting in half an ADR apart is what it's always done, the ADR reversal strategy. I'm just not used to it because I always trade. This is partly why I've written this on here. I've written it on there for you guys as well, but I've written it on there to remind me what this is doing because I don't trade this normally. Just because I'm always H1 or H4. I always have been. The other strategies are not my favorites, but they've had really good results on complete autopilot. So I thought, well, what the hell? Well, I'm going to get over leveraged and I'm going to get squeezed at the same time on all of this stuff. This is what worries me slightly, but risk is there and it's all right. So we'll be fine. Looks like a whipsaw on the DAX today. Yeah. It's a whipsaw on both. They've just taken out the pre-market high on both, basically. So they're taking the pre-market low and they're taking the pre-market high. So it's just clear the decks. We'll see if we get any speculative moves in, but it might be because of CPI. We might not get anywhere, but we might get one of those grindy days where we just kind of do that. And then, you know, we'll just about get up to there and then we'll try and get out on a grind down. But you never know. Bailey might suddenly come out this morning and go, hey guys, we decided to drop the interest rates next week. And then the pound will fly through the ceiling and the pound will fly through the floor and the FTSE will fly through the ceiling. Same with the euro. We just, you know, something could happen newsworthy. Unlikely. Nothing's happening at all, is it? It's one of those weeks this week. Just frustrating. Mumo, I'm a big fan of H1 hedging. It was a way of keeping someone on the edge of their seats constantly. Yes, certainly kept you on the edge of your seat if you're trading it. It's one of those strategies. It reminds me of when I first started trading after the Swiss peg removal. I was trading an account at the time with, who was I trading with? I think that was an Axie account when I started trading with Axie. And I remember clear as day one sleepless night where I was trading a strategy which was a hedging strategy. And I went to bed in about 35-40% or something of drawdown. And I suddenly woke up in the middle of the night with this cold sweat sort of thing going on, going, I've just remembered, if the yen positions close out, I'm going to go in bigger drawdown. They're going to margin call me. And this was about a 10 grand account or 8 grand or something. It wasn't a massive account, but it was enough. And obviously what happens on a margin call with most brokers is as soon as you get margin called, they just go, yep, shut the lot. So basically you lose 30-40% of your account. And it was just one of those things where if you're, this is why I'm not a fan too much of that H1M5. With RoboForex, not so much of a problem because I've got high leverage. So for me to get margin called, it has to basically eat the entire account. I need to be on a 15K account. I need to be something like 14.5 grand in drawdown before I get a margin call. Not really an issue. But if you're trading with any lower leverage, you've got to be careful, because your drawdown, when you get margin called, they shut your account. Basically, they just liquidate all your positions. Some brokers liquidate most highest drawdown trades first, and they will liquidate you until you're within margin and stop. Some brokers just liquidate your entire positions. So you've got to be very careful. So if you're trading at the hedging strategy, and this is why I always shied away from the hedging strategy, because I have been stung in the past. I've been margin called on strategies with high drawdown, which they're very, very profitable. But obviously they're very dangerous from a margin perspective. So you just got to be careful. If you're using sort of 1 to 50, 1 to 100 leverage, 1 to 100, you should be all right, really. But anything lower than that. What happened on that yen trade? It hit target. So I got partial liquidated. It was basically, I remember, it's really weird. There's certain things in your trading career you remember, and it's the painful lessons. The ones you go, I'm not doing that again. And it wasn't because of what happened or what I did. It was because of what happened to me. I woke up in the middle of the night going, panic. I couldn't get to sleep properly because I was worried. There was basically there was yen news coming out, and it was an interest rate or something coming out overnight. So I woke up and I had to go and check my charts, because I knew it was like 2 o'clock in the morning or something, and I was waiting for news to come in. And basically, I remember it because it was a pain point. And this is what I was saying. When you're learning to do this, you have things where you'll suddenly become less loosey, is the only way I can describe it. You don't make it in this industry by getting a good strategy and getting better at a strategy. You make it in this industry by removing what makes you lose. Because if you remove what makes you lose, you're just left with what wins. And that's how you make money. You don't make money losing it. You make money winning it. So if you remove the losses, you automatically become more profitable. So you remember the things that you lose. When you do stupid things, revenge trading, martingale. First time you try, everyone's going to do it. You go out there and you go, I'm going to do a martingale strategy, and it works brilliantly. Then it blows your account. You're like, I'm not doing martingale again. You'll remember that. Yeah. So it's just things you just remember, stuff that goes wrong. Might as well have stayed in bed with these markets. Yes. If only John Wick had told me it would be like this. Yeah, in his crystal ball. Well, was I risking too much? Yeah. I was over leveraged. And this is why I keep going on about hedging. Every time people always mention hedging in position trading. It's one of those things, everybody that's new to position trading, they look at it and they go, well, why don't you just hedge? And I say, try it. It's really good on paper. There's lots of courses on YouTube that will teach you how to do it. Try executing it. You have got massive problems with psychology as a trader. Yeah. What hedging does is it quadruples your psychological problems, because not only now are you right on a trade and have a problem knowing where to get out of that, you are wrong on a trade and have a problem with how to deal with that. You also have a locked-in loss, which you've now got to deal with. And then you have the problem of when you get out of that trade, what do you do next? Do you short it or do you wait? And when you short it, then what do you do with that double hedge you've got on now? Should that second position be bigger than the smaller one? What happens if there's a million things going on with one instrument? Imagine trading 28. It's unbelievably complicated. On paper, people go, when that goes to there, that goes to there, you shut that out and you shut partial that. And you get to the middle, when that goes like that, you take that profit, you use that profit to pay that. And then when that happens, you do this, that, and the other. And you go, oh, that's really, really easy. That's logical. That makes sense. Try executing it. So I basically, on my account, I got myself into a hedging nightmare just as a massive news event was coming out. And the problem was I was hedged unevenly. So if the news went my way, I would make a good amount of money, close it out, put it in the bank, but my drawdown would go like that because I was just left with losing trades. And that is where you hit your margin. So you go, bank a load of cash, fantastic. Margin call, shit. But these are lessons, which is why I've always shied away from hedging. And this is where I got to this with the EA that I've been developing, with the hedging strategy I've been developing. In the back of my head has always been this doesn't work. It's too hard. And now when you're trying to program the logic of what to do, you realize how bloody complicated it is. The maths has got to be spot on how to exit these things. And it's very, very, very difficult. There's not many hedging EAs out there. If you go and look, there's not many out there, and there's a reason for that. Very hard. But anyway, just talking because I'm waiting for stuff to happen. Okay, we're out the highs on the DAX. So pre-market, we're long. FTSE's trying its best. So it does look like we're going long today. So basically what that means is we're leaving gaps in play today. So we have got gap fills to the downside to worry about. What was the reason for the time filter is needed for ADR and not for others? There isn't a reason for it being needed for one and for the other. You should it's up to you. The time filter basically is there to stop trades being taken at swap. Yeah. So that hour at the swap, basically, the New Zealand dollar is the main problem. The New Zealand dollar spread goes through. I've seen ADR. I've seen it spread an ADR at the swap. So you tend to, I have in the past, tend to filter out that hour. So I say to the EA, do not take any reverse alerts that happen before 1 a.m. But I haven't set the time filter up. It's not the end of the world at the end of, it's really not the end of the world. I'm not that bothered about it at all. Some people are really bothered about it, but it doesn't bother me. Because I will come in here and I will manually, like I did this morning. So we've got that position on this one, isn't it? On the Aussie New Zealand. So there's two positions on that. So basically I'm checking my charts all the time. So I've gone, oh, look, these are too close together. I'll deal with that one. Worst case scenario, if this had got me into that and then it had pushed up and I was sitting up there, I would go, okay, I've got double on my first. So maybe I'll shut half of it out. I would just deal with it rather than not have it happen. Because you get also, don't forget, there's always two sides to the coin. Oh, you got too close together. What if it had gone against you? Yeah, but it's gone too close together and it's gone my way. Happy days. Sometimes it works nicely. So it's not the end of the world, is it? We're dealing with such small position sizing, it really doesn't matter. I don't understand margin calls. I thought you'd have to be in like 95% of drawdown before the brokers take action. That depends on your leverage. You've got a margin. Yeah. Mine is 26,328 because I have a 1 to 500 leverage account or more. I can't remember. This might be a bigger one, actually. They give you 1 to 1,000 now at Robo. I can't remember. I just take whatever the maximum is because I don't really care. It's all the same. If you go with 1 to 200 or 1 to 1,000, it's the same. You don't get a margin call until you're fully exposed. If you've got 1 to 50, when you get to 50% of your account balance in drawdown or your margin drops below 100%, they shut you out. If you're trading with Robo Forex and you've got any leverage over 1 to 200, margin is just not a thing anymore. Margin is only at Darwin X. Margin is a thing. Yeah. Look at my margin on Darwin X. 19,700. Yeah. So basically, if I close out, but this is because I'm hedged, yeah, on both, right? So I've got 20,300 in the account. I've got 19,600 or 700 because I'm hedged. So it's that minus that and that. Yeah, basically, pretty much. If I close out the longs now, I will be in drawdown on that. That margin will drop down to somewhere in the region of 200%. When it gets to 100%, they close my positions. If I take aggressive shorts, yeah, I'm doubling my short exposure. When it goes up, my margin drops at twice the rate. So if you're using something like 1 to 30, which I get with Darwin X, you need to pay attention to margin, which is why people are saying, why am I getting margin called? Why am I not getting my trades on? So they're trading the 3 indices in the afternoon in the US with 0.25%. If they all go, that's fine. If they all get hedged, and then one of them gets out of that hedge, you're close to a margin call, even if you're using 0.25% risk per entry. You just have to monitor it, but don't worry about it. If you're trading on Robo, or if you've got a 1 to 100 or more account, you just don't need to worry about margin. It's irrelevant. Why did you drop the MRA EA stop loss support and resistance prop strategy? Because I'm not trading prop anymore, basically. I don't need to use a stop loss. You can trade it. I mean, it's very, very simple. Where's that Hedging gone? Look, short here, stop loss, half an ADR. So go short at that resistance bounce. Your stop loss is half an ADR, 53. Somewhere around there. Yeah. It either goes down and I take the money, or it goes up and I get stopped out. There's nothing complex in it. So all I would do is, all I did on prop, very, very simple, was I would every morning go, right, what we got coming up today? Nothing. 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 That's just broken out. Missed it. Aussie, New Zealand, nothing. I'm not going to find anything, am I? Because the market's not moving. CAD Swiss. Right, okay, CAD Swiss. So yesterday evening, I would have gone, okay, that looks good. So I will open my VPS, open a CAD Yen, stick the market reverse alerts EA on there, and say short only on the hourly time frame or the 15-minute time frame, whatever time frame you fancy, and just say, take the next reverse alert short for me with half an ADR stop loss. That's it. So all I'm doing is I'm looking through the charts and going, are we at an area of support resistance? If yes, open a chart, stick the market reverse alerts EA on, pick the direction, long or short, and then say, get in there with half an ADR stop loss using X% risk. I was using 0.5%. That's it. That is the strategy. Literally, I'm playing support resistance bounces. Nothing more complex. There you go. There's one there. Look. So if I'd have, I mean, this happened overnight, this one, but yesterday, look, beautiful. Look at it. Hit, 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 roughly hit, hit. Yeah. Yesterday, we were sitting there. This thing's hit this 1 billion times, this level, and it keeps bouncing. So let's say I spotted it here. I would just literally stick the market reverse alert CA on. So drop down to 15-minute time frame or whatever time. You can use the hourly. I was using the hourly basically a lot of the time because it's more accurate reversals basically. So yesterday, that was a high. So that didn't make a new high. That didn't make a new high. So this reversal alert here is actually the first one. So yesterday, I would have put the market reverse alerts EA on there and said, go short on the next 15-minute reverse alert. And it would have taken that short there. And then it would have had a half an ADR, and I think I was setting it to 1.5 ADR pre-R, yeah. So I was setting it to 1.5 ADR to automatically put a TP in, just in case you got a stupid news event or something that flew down. But I would manually then adjust the TP to whatever. That's it. It's that simple. Because what we know, that's what price does. It comes down to this area and then it bounces off of that area. And then when it comes back to it, it bounces at it until it doesn't. So when you get to an area of support and resistance, it is either going to hit limit order triggers that triggered the short last time and work, or it's going to break out and it's not going to work. So if you set half an ADR on that and anything higher than half an ADR target and you get a 50% strike rate or higher, you can't lose, can you? We know support and resistance works. And 80% of the time, the market spends in a range. It spends somewhere between 20 to 30% of the time either breaking out of a range or trending. So 80% of the time, your support resistance bounces are going to work. The problem is what people do is they try to pick the exact top and then they put their stop loss there when the market's down here. And of course, what you get is an M pattern reversal. So they get stopped out and then the market goes their way. So when you get to support and resistance, give the thing half an ADR to breathe. And then, yes, I'm not looking for 5R. I'm looking for, that worked, take it. Whatever that is, it doesn't have to be 2R, 3R, 4R, 1R, whatever. Yes, it worked. Brilliant. Take the money. You'll find your strike rate will be a lot higher than 50% if you pick solid support resistance, weekly, monthly, strong, not daily, good, strong. And if it's been tested a couple of times, even better. But look, it's not accurate, is it? That is not the same as that, which is not the same as that, which is not the same as that, which is not the same as that. But this is the same area there, which is previously resistance. Which is why in that video I've got on YouTube and on the website about how to draw support and resistance, it's not a line, it's an area. It's a price area where we test and see if the sellers that were selling from that area are still there. If they are, we will have a fight with them to see if we can get through, and one of them will win. That's what happens at price points. Banks and institutions argue over we should be higher or lower than the current price. If we're happy, we go into balance. If we're not happy, we break out or we mean revert from that level. So you're never going to get them hit that level to the pip. They're going to fight over it. Yeah. What does price do 58% of the time? Move within its average daily range. So if you pick roughly half of its average daily range, you've got a good chance of not getting stopped out if the sellers win the battle. That's a news event. Nothing you can do about that. You're just stopped out. That's literally the strategy. Just playing support resistance. It's very, very simple. But you've got to be patient. You've got to do it on the hourly time frame. If you try and do it on the 5-minute time frame, you're just going to get chopped to bits. Because the 5-minute time, you need that half an ADR. You need space. You need breathing room. This is where everybody goes wrong when they're trying to trade with a stop loss. They go short here. You go short there, right? Let's say you took that candle there. It moves down, right? Your stop loss is there. See, we've traded higher than that in the last 2 days. It's nuts. The stop loss should be up there somewhere because there's a good chance that this is going to come and retest this level and see if we really, can we get through that level? Nope, not at the moment. Right, let's take a run up. Can we get through that level? No, definitely can't. You're stopped out. I'm not. That's just an M pattern reversal. So everybody gets it wrong. They just try and get the stop loss. And then what happens is it pushes down and you get down to there and you're like, hey, the trade's working out. Let's go to break even. And then it pushes back in market structure, stops you out, and then goes to your target. That's what everybody does, isn't it? It's stupid. It's nuts. Don't do it. Basically, that's all it was. So literally all I was doing was sticking the MRA on and saying short it. And if it pushed above that level, because I'm obviously checking my charts every few hours, if it pushed above that level, I just take the EA off and go, it didn't work. Yeah. What about reverse martingale? Try it, Emperor. Increasing risk after every win. Try it. Think about it, right? If I increase my lot size every time I have a winning trade, what am I doing? Yeah. When I get a losing trade next, how big is the losing trade going to be? Bigger than the winning trade. That's just nuts. Try that. Backtest it. Build an EA. There's a load of there's lots and lots of gambling strategies that sneak into trading. That's one of them. There's martingale's a gambling strategy. It's a Chinese gambling casino strategy. Martingale. It's just there's lots of those types of strategies that work for a period of time, and they always work well for a period of time. But you will never find a professional trader or a bank or an institution using anything like that. Because it just doesn't work long term. I use a tiny lot multiplier for scaling into my positions, not because I'm greedy, but because when I get my entry on, the odds of my entry working, I believe, are good. When it pushes further against me, the odds of that initial entry being right are obviously wrong, but the odds of the second entry are higher because we were extended there. Now we're even more extended. If we get another position on, the chances of that pullback are even higher. So the risk increases as the probability of the snapback increases. That's why the partial multiplication on the market reverse alert CA is there. It's there not because we're trying to keep that average close. The odds are going up. Yeah, as RSI gets extended and price doesn't come down, the odds of it coming down get higher. When we get below that 80-20, that above the 80, below the 20 level, the odds are incrementally so much higher, aren't they? So we scale in that respect. Yeah. So you'd have got in there looking for the pullback, and then it pushed all the way up above the 80 level, and then it did the pullback. The odds were much higher above the 80, above the 75. There, look. But if it doesn't work the first time, because the banks haven't taken the profit, they will take the profit at some point. If they didn't do it there, the odds of them doing it the next time they push is higher. The odds of it doing next time is push. It's like Steve Malraux's. Steve Malraux came up with a 3 push strategy, didn't he? So the market moves in waves of 3. You push, you accumulate. You push, you accumulate. Third leg, market structure tends to shift. Yeah, the 3 pushes, which is a sound strategy. But I've experienced 5 pushes, 6 pushes, 7 pushes. So as a strategy, if you just take the 3 pushes every single time, the odds of that happening are higher. But the odds are still 50-50. But the odds are higher because we've had 3 pushes without a profit take, which is equivalent to RSI getting extended 3 times over a period of 2 or 3 weeks. You could take that if you want to. You've got to be very disciplined because all those ones that you miss, you'll be kicking yourself. But that is a theory. Extended, no profit take. More extended, much higher chance of a profit take. If that doesn't work, much more extended, much higher chance of a profit take. So if you increase incrementally your lot size ever so slightly, all you're doing is you're making that easier to get out on. But we're not using martingale. If you used martingale on it and it went 7 pushes, you're dead. You've blown your account. Can't do it. Which is why obviously exposure is key as well. That's why I'm finding the SIH strategy kind of tricky because for me, because of the hedging aspect. But the stock index hedge is simple because it has a timer. This is the difference between hedging Forex and hedging indices for me. Indices are an intraday 5-minute scalping tool. You should be scalping indexes, I think. You can invest in them, obviously, long term, do whatever you like. But I think these are a really good intraday tool because we have a period of volatility we know is coming. We have 2 a day. This afternoon at 2:30, the DAX is also going to get a second wind. I know that because the markets are going to open and the stock sector purchases are going to drive the DAX as well. So what we can do is we can go for the break and it will work or it won't. If it doesn't work, by the time we get to 2:30, we shut it. Yeah, that's the difference. So we're getting into a hedge and we're saying to the market, please get me to a level that is a really nice stretch by the time the US market opens and get me out. If you haven't, okay, I'll take the loss. But we shut it. The US, we shut at the night. With a normal hedge on FX, you take a trade, you get hedged. You wait for that to happen. 3 weeks later, you go, right, I'm getting out of the short. And I'm going to hope that this pulls back to a point where I can get out of my long, but it doesn't. It pushes back down again. Yeah. There's no exit plan with hedging. This is the bit that gets me personally. With this, there's an exit plan. Yeah. 2:30, I'm shutting. I don't care what that is. It's either a profit, it's a loss, whatever it is. I'm shutting at 2:30. That didn't work. On to the next. We've got a time that we stop trading. With any other hedging strategy that you're trading, the idea is you get out of the hedge eventually. How long is that going to be? And this is what I'm finding in all my testing is it could be 3 months you're sitting in a hedge, managing it. Talk about hard work. I'd rather go and work at McDonald's. It's easier. Probably get paid as much as well, because for that 3 months you're in that hedge, you're going to struggle to make any money out of it. Horrible. But with this strategy that we're trading here, the H1 hedging strategy, this is position trading. Yeah. So this is a hybrid. We are hedging because we don't know which way the market's going. And what we're going to do is we're going to scale into the one that doesn't work. So one works, guaranteed profit. Other doesn't, turn it into a position trade. Yeah. With a normal hedging strategy, there is no scaling in. There is one long, one short. One long, one short. One long, one short. Or you trade an inside hedge and you go 2 long, 2 short. But there's always an equilibrium. With position trading, we don't have equilibrium. We scale into the move because that works. Brilliant. Well, that didn't. So wait for that to come down. And then we get out of that one. Yeah. And if we don't and it pushes further, we just keep getting positions on as normal until we get out of it. The downside is you're going to get squeezed more because you're not waiting for extensions to get in. Yeah. So I've gone short at the 40 RSI. I would never do that in the real world normally, would I? But I haven't got a choice because there's a reversal that says the market's going short. Different strategy. But I just find it a nightmare. But the stock index hedge is why I love that strategy, because whatever happens at the end of the day, you just accept it. I'm out, done. Whatever I've got is it. It's whatever the balance is, the balance is. It's either worked or it hasn't. Move on. Much, much nicer. And this is nice as well, because when this works out, I go, oh, that's a nice profit. I'm in a position trade short. I'm in short with a nice, comfortable position. I'm used to trading it. And I know how to get out of it. And I will do aggressive drawdown control if necessary as well. That's the thing that does worry me about this, trying to do aggressive drawdown control. I would take aggressive drawdown control on positions when they get to a certain point. When this is sitting in 25% of drawdown, I think I'm going to have a bit of a psychological breakdown trying to get an aggressive drawdown control position on when I've got so much drawdown on. But I don't know. We'll see. This is why I'm trading this with a very small amount of capital at the moment. I'm still not convinced, but I can't deny the fact that this did 140% in 9 months. So I have to follow it. Hanco Trade, we're offering 1 to 2,000 if your balance is 20k. Yeah. You can get 1 to 2,000 anywhere. 1 to 1,000. 1 to 300 is enough. 1 to 300 is enough. But I think my accounts I've got here are 1 to 500s or 1 to 1,000s. That's how much attention I pay to it. It doesn't matter. It's all my margin, basically. So SIH, I do not see fixed amount of money in my settings. Was there an update? Yes. There was an update. This is version 1.2. Are you going to return back to using prop firms in the future? I don't think I am. I don't need to. I never did need to. It was a nice thing to do to make extra money, and it worked really well. But I used my own capital. One of the reasons I used prop was because in 2022, position trading became a little bit more tricky when we went into the interest rate rally. I hadn't traded through that before, and we were getting some quite tight months where we just weren't getting much happening. So that's when I decided to go back to scalping. That's when I created the opening range breakout EA. So I think it was 2022. Yeah, December 2022. So this is when I was scalping. No, it wasn't that one. Sorry, it was a Price Action Toolkit. I can tell when I started doing things by what I was building at the time, because I was building stuff to trade what I needed to trade at the time. February 22. I thought December was a bit late. So this is when I started looking into it, sort of early 2022, because we'd just come out of COVID. We'd gone into 2021. 2022, we were talking about increasing interest rates because inflation was going through the roof. So the market was going, I don't know what to do. We weren't getting many RSIs. At that time, I was trading H4 extensions, and we just were not getting H4 RSI extensions. So I said, right, I need to find another way to make money. So I went down and looked at trading, going back to my stock trading days, and scalping stocks, but I chose indices. So I built this basically, which is how I got into prop, because prop suits fast, high risk trading. Yeah, it's like you've got to hit 5K within 5 days. Well, that's or 8K or whatever it is on a 100K account. So that's why I basically got into prop as a way to ease myself back into scalping, but without risking my own capital. So it cost me $500 to get 100K worth of capital, and obviously blew the valuation, blew the next one. I was like, well, this is hard work with this drawdown. So I said, right, well, if we reduce that down, we'll probably last longer. So did that, and obviously it took too long to get funded, and then you got your account blown, and then it's like, right, that doesn't work. So that's when I came up with the strategy of buying 10 evaluations, using the same strategy on them, stack it out, and you've got to hit a lucky run. You've got to have those trades work for you, and you've got to have a run of 5 or 6 days where it all pans out exactly as you plan it. So you lose 6 or 7 of them, you get 3 of them. And out of those 3, you just need to make 5 or 10 grand. Yeah. Got to pay the mortgage, basically, at the end of the day. Need minimum of 5 grand to pay the bills. So if I can make 5 grand out of prop, if I spend 10 and get 15 back, there's the bills paid. That's the business model. All worked well. That's where the ORB strategy came from, which is an old strategy I used to trade with Canal Desai, and that's where stock index hedges come from, which is a variation of that strategy. So yeah, that's where it all came from. But I now fund it with my own capital. Thanks, prop. I earn a lot of money out of prop very nicely, but I don't like having rules, restrictions. This thing that happened to me yesterday on the DAX, look, where the terminal froze and I couldn't get out. Well, it just didn't close the positions out for me, where it should have done, because I just wasn't looking at it. And that's basically a happy accident, isn't it? But that would have also probably blown the account because it probably went to 5% of drawdown. Look, it took a 3.27 loss. So at some point, that probably would have hit 5% on the day, which stops my account out. I haven't lost any of my own capital because I don't have a stupid rule for 5% drawdown, because these things happen. It's part of trading. We've just broken down quite nicely now. Market's decided it has got a direction. Funnily enough, it's come off of a weekly resistance. Yeah, so that's basically why I am not trading prop now. I just don't need to. I have capital to trade with, so I'm trading with my own. And doing the same sort of thing. But it's just another string to your bow. The more strategies you have and the more variation you have on your strategies, the easier it's going to be for you to trade. So when the market's flip-flopping around like this doesn't do very well. Position trading will take over. When H1M5 is not doing very well because we've got no alerts, the ADR reversal strategy will start making more money. So will the hedging strategy get stuck because the market's not moving. When the market goes into a trend, the hedging strategy will make a lot of money, but it will also get into a squeeze. But if there's lots of big ADR reversals and market structure's nice and clean, the ADR reversal strategy will clear up. The stock indexes will start going mental. The opening ranges will get stronger. Therefore, this will start to make a load more money as well. But H1M5 will probably go into drawdown and have a loss month. Yeah, you've got to have diversification across your capital, because one strategy is fine, and I've survived very well on it in the past, but it's much more comfortable having diversification. And if you want to do that by using prop, do it. But I don't need to be having those rules. That's the thing. It's the rules. They kill you. I lost 90% of my accounts with prop, evaluations and funded. Well, funded obviously anyway, but evaluations, I lost 80, 90%. I haven't even done maths on it, but it's a lot, most of them. Because you can't have a strategy that works all the time. This one right now could do, I've done 6% on it this month so far, all going well. But look at that. I had a 2.96 down day there. Admittedly, this is fairly high risk. This is trading 2% a day. So what if that day had been 2.96? That's negative 6%. I've only got a 10% overall target. Yeah. So you have 4 losing days on the trot where the market basically just goes into, I have got no idea where we're going for 4 days. That's it. You're blown. But day 5, slam, 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 3%. Slam, 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 3.5. Slam, 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 3.5. I've just made 11.5%. I'm up 1.5% over a period of 6 days. Happy days. But the proper valuation kicked me out. I've got to start again. That's just cost me another $500. Nothing wrong with the strategy, but it doesn't work within restrictions. No strategies do. This is the problem with prop. This is what people don't get. They get enticed by the, we will double your account every time you hit 10%. You're not going to hit 10%. Every time you get 10% profit on your funded account, we'll double it. No, you won't. No one gets there. It's the problem. It's all, again, like hedging. Looks good on paper. Try it. It can be done. I believe it can be done, but it's just not the way that I like to do things. I don't want rules. I don't want restrictions, and I want things to happen faster. I could position trade an account. I'm pretty sure I could pass an evaluation, and I have done it with stage 1 with a position trading strategy with tiny risk, and it will take me a month. But what am I going to get out of it? Stage 2. Then I've got to do another one. 2 months later, I'm funded. Excellent. 1 month later, I've produced $5,000 in profit. 3 months it's taken me. That's $1,500, and they're taking 70% of that away. It's not worth it. It's just not worth it for me. But obviously everybody's different, so we're not all the same. Stuff's not going anywhere at the moment. I'm new here. How do you measure half ADR? You get ADR and you halve it, Andre. So I'm trying to think of a clever answer. It literally is half of an ADR. So ADR on the CAD yen is 105, 102. So it's 52 and a half. Have I misunderstood the question? If I have, let me know. But yeah, it's just literally half an ADR. Half. So that's ADR high, that's ADR low. Halfway to it will be half of it. Did you follow this method on prop firm accounts? To be so, yeah. So that's basically, you're talking about the support resistance. Yeah. I was also scalping as well, and I was using the opening range breakout strategy as well. I was using all sorts of stuff. The stop loss based strategies mainly I was using on things like the FX pairs where we've got decent levels, and I was also adding. It was very discretionary. There was no rules basically with it. This is the problem I find with prop. It's not real. It's not real money. It's like trading a demo account. You are trading a demo account. You treat it like a demo account. Yeah. So if this CAD yen, for example, if this starts to work out and it suddenly flies down to there and it pulls back into a propulsion gap it's formed, and I see that drop, I'll put a pending short order there, and then I'll put another pending short order there, and I'll wait and hope we get down to there, and I'll make 4 or 5% on that trade. It's not the sort of thing I would do in the real world, but I don't care because it's not real, is it? So I made, I passed an evaluation on E8. I've said this many times in here before. I passed an evaluation on E8 in the morning, trading the DAX. And then in the afternoon, I passed the second stage on the NASDAQ using stupid high risk and just scaling into one trade. That's what it is. It's just luck and gambling, because I would never do that in real life. Try and achieve an 8% return on a session. That's ridiculous. You can't sustain that. But on prop, if you can do it twice, you suddenly get 100 grand. It's a game. Then you drop your risk ridiculously low, because that is not going to work. But that's the strategy I was doing most of the time on FX. It's literally support resistance. It's all you need. And there was one account on it wasn't on the Fivers, it was, it might have been E8. Can't remember who it was. But basically, I went in with 2.5% risk per trade. And I passed the evaluation straight away. Because all you need is one ADR or a 3/4 of an ADR pushed down with a 2.5% risk. Yeah, that's 2.5%. Do that 3 times, you've passed your evaluation. Simples. And all I need is a 3/4 of an ADR move. But it's not what you would do in the real world. You would never use that level of risk, would you? But support resistance is, I go on about it a lot, don't I? There's a reason. It's not because it doesn't work. It's because it works. It's support and resistance. This is why these lines are on the chart. Propulsion gaps are dynamic support and resistance. Weekly highs, yeah, that weekly high that got hit again didn't get hit through chance. It got hit because that's where they sold it from last time. Why? Because that's where they bought it from. And now the sellers lost control, or the buyers lost control. The sellers have taken control. So the guys that sold there added again and added again. Why support resistance works? It's banks changing the direction of price. If they are short, they are short. They didn't go short for fun. They went short because they want it to go down. If it comes back and you try and go through there, they're going to say, no, we're going short. That's what they do. This area here, we bought it from 3 times. Then we failed. So we sold it. This is all one level, but it's not a line. It's an area of price. So you've got to get the sellers on side roughly around the area, which is what the reversal alert does. That's what the indicator does. It shows you who's in control. At the moment, the buyers are in control because the guys that sold lost. We're long. Here, the guys that sold have tried to take control back. Will they succeed? Don't know. Tune in next week to find out. I have no idea. But at the moment, they've just taken control back at the previous point they took control at last week. Yeah, it will either work or it won't. But you've got a really simple set of rules and a really simple stop loss strategy for anything. It's the interbank algo. Yeah, it's the interbank. It's the intercontinental bank. Ujimi flip. What's them have called? That's why that happened. I can sell you a course on it for £2,000 if you really want to know all about it. Yeah, it's just, but it's all it is. It's repeating. Market repeats itself. The market has a memory. I'm shutting my longs or shorts too early on the SIH. I'll leave it until about 2:30. Yeah. Close your shorts shortly after the open because it looked bullish. That's, yeah. So if you're closing out now, but the thing is, Brian, some days that will work. Some days that's the right thing to do. Some days it's not. But until what I want to see when I'm in a hedge, I do close out earlier than target sometimes. When I've seen something that makes me think we are definitely doing that. Yeah. So if it had done something like that, at that point, I would be saying we are forming market structure long. So close those shorts, and then I've just got to get that much distance up above there to get out with a break even on that. Yeah. Because when it hedges, the idea isn't we're not looking to make a load of money. We're looking to just exit the position with as minimal risk as we can possibly get. So, but when it doesn't give me any indication, so it's like it's just pushed up above the highs. Yeah, that doesn't mean it's going long yet there, does it? And then it's broken back down. This doesn't mean it's going short. This is a support area. We bought from here quite a lot. So good chance it's going to go up. But if it hits that propulsion gap here, yeah, and we get a big sell order come in, and then it does something like that, I will probably go shut the longs. Looks like we're going short. Yeah. If we break that low there, it's probably going short, but it's too far away for me to get out of the shorts now. I might as well wait and see what happens when we get the gap fill. Every day is different. This is why I keep saying that you can't have an EA that trades for you 100%. There's too many what ifs. There's too many ifs and buts in trading. It's too discretionary. You can't, there isn't a set of rules that unfolds every day the same way. There isn't a set of candlesticks every day that is the same as a previous day. Every day is unique. Today, it looks like it's going short, and I think it probably will because we've got gap fill. So I think it will probably do the gap fill. Now, if it gets the gap fill, and then it suddenly has a whacking great green candle, and it pulls back inside there and then breaks that high again, good time to exit those shorts probably, because it looks like it will probably pull back up, and we will probably have a propulsion gap to come and trade back up into. At the moment, we haven't got a propulsion gap. So when we get to here, again, my view will have changed. Discretionary. So you either leave it and say, oh, screw it. Either you're going to go for a run or you're not. Or you try and work the hedge. That's dangerous because this is a 5-minute chart, and every single one of these candlesticks is literally just the imbalance between buyers and sellers over a 5-minute period. It's got nothing to do with the direction. It just shows you what happened in the last 5 minutes. Doesn't mean it's going up because we had a bullish candle. It means in the last 5 minutes there were more buyers than sellers. Doesn't mean it's going up. What it will do is aim for a level it's been to before to see if we can trade below that level. There will be limit orders which will push up. And this is the idea behind the aggressive exit in the SIH. We don't need it to bounce there. We need it to react. If it reacts, we're out. We don't need it to come back up. We just need a small movement to exit this hedge. We need that much movement. That's the hedge. We need that much movement when we get here. So all I want is you to bounce that much up from there. I don't care if you go up. I don't care if you go down. I want you to do that so I can get out of this. That's what we're looking for. If you try and do it now, i.e. let's exit our longs here because it looks like it's going short. If it goes up to there, you're just going into drawdown on that short, but you've got no long profit. That's the danger. All we're doing is buying ourselves time. We're saying, right, you don't know where you're going. I don't know where you're going. I know where you've been and where you're likely to head. Let's see if you get there. If you get there, I've got a chance. If you don't, I'm screwed. I'll just take a loss. That's it. That's the strategy. That's the way you've got to think about it. It's patience. Again, this stops you over trading. The whole idea is the whole idea of the SIH, the ORB strategy will trade over and over and over again, trying to get this direction right. The downside to the ORB strategy is in this kind of market condition, you get stopped out, stopped out, stopped out, stopped out, stopped out, stopped out. It overtrades. On a break, it's no problem. The SIH strategy will never let you overtrade. You can't overtrade because unless it goes somewhere, you can't take another trade. You're in it. This is it. That's it. That's it. That's it. That's the outcome today. The outcome for me today at the moment is $600. Unless we get there or there, then I've got a chance of getting out with a profit and a profit. But I'm not going to keep trying to guess the direction and lose 1% every 10 minutes because it's changed its mind. Stops you over trading. One of the biggest killers in trading, over trading. That didn't work. Try again. That didn't work. Try again. It's going up. It's going down. It's going up. It's going down. It's going up. It's going down. That's 5% of your account. Shit. Better double my lot size. That's 10% of your account. Stops that because maximum risk is 3%. Not do any more because it literally is not going to do any more trading, is it? There was a trader on a podcast who trades ICT, and he was like, I have a secret document proving all of this. He showed the document, and it is literally a letter from a clearinghouse. Bizarre, isn't it? But people listen to stuff, and people... when I first discovered ICT, when he first came out and he started talking about the IPTA, I was like, oh, that makes sense. Because we know computers and algorithms run everything. So it would make sense that there's an interbank price delivery algorithm that clears all of these. And then I suddenly met Anton Creel, and he worked in Barclays. And he said, well, no, there's no central exchange. How can there be a delivery network for orders when the orders are done over the counter between banks? That doesn't make sense, does it? No, it physically can't exist because 90% of Forex transactions are OTC. They don't go through a central exchange. They go over the counter. So how can you have an interbank price delivery algorithm delivering price between foreign currency pairs when the banks aren't conducting business through an exchange that could physically do it? It cannot exist. It is a lie, a scam, a con. It doesn't exist. Ask anybody in banking. Go into a bank and say, I'm interested in a job in banking. Okay, I'm interested in the IPTA. Watch what their faces do. The what? The what? No, it's just nuts. Very much different strategy from me. Just have to get used to it. Yeah, adapt. Do it on demo, though. Adapt on demo. Don't adapt on live. My manual intervention in this strategy is literally moving my targets. That's as much intervention as I do. Every now and again, I will see a price action move and I'll just go, that looks so bullish or bearish, and I will try. And 50% of those, I will go, that didn't work, and I'll re-hedge it, and I'll take a bigger loss than I had in the first place. But Some of those times it works, but not often. I'd much rather wait for price to do what it's doing now. Make its bloody mind up. Where are you going? If you're going short, where are you going? It's what trading's all about. It's not about getting the entry. It's about knowing where price is likely to head. We're heading to the gap fill. Yeah? Because that's what it does. It fills gaps. Then we're heading, well, that's not even real money, but so the gap fill actually is really down here. But so when we get down to here somewhere, we'll probably get a bounce. But will it be a big enough bounce to get me out of the hedge? That's a gamble, isn't it? I'd much rather they come and test yesterday's low, because we definitely know they bought that, because they've also bought it here. So this has got much more relevance to me for a bounce. And we're likely to find limit orders. This is the big difference. Banks bought that. They bought it. So they will be buying it again because they bought it. That's the difference. You're going to find that's going to happen. That's why support and resistance is a self-fulfilling prophecy, why it works. Because the guys that said we'll go short there, when we got down there, they set more orders there in case price came back so that they could drive it back down again. Those limit orders trigger automatically, or other algorithms trigger them automatically. Not the IPTA, just algorithms, just banks. But, you know, who really knows what goes on? Overtrading was my downfall, yeah. Overtrading is most people's downfall. One of the biggest problems in trading. Overtrading. It's not a secret if he has it. Good point. Have I met Anton Krill? Not in person. I've spoken to him on a live seminar. No, not met him. He's very matter of fact. He's very much like me, I think. It's just like, stop listening to bollocks. This is how it works. You ain't got a clue. This is how it works. That's it. There is nothing. There is no magic going on. It's banks dumping thousands and thousands and thousands of orders. That's why that candle's going down, because the banks are selling the crap out of a load of stocks in the German stock market. There's nothing else going on. There's not enough people that are willing to buy them, so therefore they're having to push the price lower to find people to complete the orders for them. At some point, they'll finish that order, and then they will stop. When they stop, the buyers will take control. That's what's happening. At the moment, Barclays have got a load of stock to sell. HSBC haven't got enough to buy, so therefore they're just filling Barclays orders as they come down. Or whoever. There's loads of banks, but that's basically what the mechanics of this thing is. Buying and selling. And you have no idea when Barclays are going to stop. Neither do they. Because think about it. You're sitting at a desk at Barclays going, short, short, short. Your pile's going down on this side. You're going, short, short, short. And then some bloke comes along and goes, there's the natchbacks of orders, Bob. And you're like, are they all shorts? Yeah. Short, short, short. When Bob's run out of shorts, he's going to go, I'm off to lunch. All right. And then everybody that's been buying the crap out of it all morning, all of Bob's orders, they've been buying them. They're like, we are so long. We need to get out of this. Drive it back up. Because Bob now has got no selling pressure. The buyers will go, right, who wants to sell to me? Well, Bob's not there anymore. Has anybody else got any orders? Yeah, but they're all the way up there, look. All right, we better go up there and get them. That's the simplest way I can explain what happens in a bank. It's just people pressing buttons because they're told to. Mechanics, it's economics. It's me waking up this morning and going, I think Mercedes is going to go bust this year. Can you sell my Mercedes stock? That's what's happening. People are just going, I don't want Mercedes anymore. And then someone's going to go, I want Mercedes. Bob. It's always Bob in a bank. I think I use Bob in the Bootcamp, don't I? Is it Bob and John, I think I use in Bootcamp? 90 people watching, only 2 likes. Come on. Why has nobody liked me? I don't know. All that ICT promises is double your account in a year. Does he promise to double your account in a year? Which is less than what I'm doing. I'm not doing much more than that. That's realistic, though. That's the only thing I would give him. It's realistic, isn't it? Yeah. He's not saying you're going to double your account every month. Yeah, doubling your account in a year is achievable. That's 10% a month. Less than that, it's 8% a month. You can return 8% a month, no problem. That doubles your account. That's achievable. Anybody quoting you 5 to 15% a month is realistic. 15 is optimistic. As an average, though. Yeah, I have 25% months, but I also have 9% negative months. They cancel each other out. Yeah, you don't get paid what you want. You get paid what the market gives you. If you're shorting the DAX now, you're getting paid. If you're longing the DAX now, you're not getting paid. The ratio between you being right and wrong is what the market pays you. You don't get to control that. H1 hedging is doing 180% a year. Well, it did 140 odd in 9 months. We don't know what the other 3 months would be. They could all be losses, couldn't they? I don't know. But yeah. Yeah, H1 hedging is this is why I don't, but think about it, right? I'm making over 100% return a year safely. H1 hedging strategy, in my opinion, isn't particularly safe, is it? Because you are constantly sitting in large drawdown. For me, that isn't safe. But then again, that is how pension funds work. Yeah, pension funds are always in anything up to 40% drawdown on the fund during the year. So I don't know. But I mean, it's high risk. It's high risk. But high risk gives you high reward, doesn't it? Yeah. So I could make the H1 hedging strategy return 60% a year by just reducing the risk. If I up the risk, I can produce a hell of a lot more than 200% a year, can't I? But your odds of blowing the account increase exponentially, don't they? I think 0.2% risk is high. But I'm going to run with it because that's what it ran with before. So I would probably rather run it at 0.1% risk, which would be safer. If it was a big account, I would not be running it at 0.2. I'd be running it smaller. Because I would obviously be making more money return because it's a larger account. Because it's a tiny account. This is a holiday fund. Just suddenly realised what I said there. This is a holiday fund. I was just suddenly had my wife in my ear going, what do you mean we're not going on holiday? What do you mean you blew the 50 grand? She doesn't talk like that. But yeah, but this is what this is. So I don't mind running it on high risk. If this thing gets to like 8 grand in profit, like 50% return within 6 months, I will probably take it out and reset it rather than let it run. Don't forget that was compounding as well, AZ. So that account that was running was compounding. Yeah. If you need to draw money out of this, you're not going to get 180% a year because you won't have compounded the account. So the account started at 100K. At the end of month 1, it was 110. So you were taking 20% risk of 110K, not 100K. So you were exponentially increasing your profits. So that 140% return, if you'd have been withdrawing from it, wouldn't have been 140%. Yeah, so that's the difference. That was compounding as well. So if I get this account up to 22K, it will obviously be taking higher risk and returning higher reward. But if I draw 7K out of it to put down as a deposit on a holiday, I'm now back to trading 15K again. The profit curve will drop. So got to be realistic. Out of my pound US dollar shorts, 3.7R. Nice. Makes up for a bit of the DAX. So pound US dollar's dropping, is it? Yeah, nice big drop there. So this is US dollar strength coming through. Indices are dropping. Euro's probably dropping as well. Yeah. So yeah, decent moves. Is that euro? Is that yen up to? Yes, yen's coming down as well. So the yen is coming down at the same rate as the US dollar. As you can see, the US dollar yen hasn't moved. Everything is coming down against the US dollar. Everything is coming down against the yen, which means the US dollar is strong. The yen is strong. You can tell that by the US dollar yen being flat. So everything starting to roll over at the moment on this yen ever so slowly. I would like to be Bob. Yes, I'd like to be Bob. Bob's got a boring job, though. Think about it. Bob, the job you want in the bank is you want to work on the speculative Forex desks in the bank. You want to work on the traders. They're the traders, the proper traders. The market maker desk, his job is to provide liquidity. The commercial desk's job is to execute orders using the market maker's liquidity for the corporate clients. The traders are on the speculative FX desks. Their job is to turn this 1 million into 15 million by going in the same direction as Bob, because Bob knows where it's going, because Bob's got 25 million shorts to put on the US dollar yen. Where's it going? Down. All right, speculative desk, do you want to short it today? Yeah, okay. That's how they make money. How can you not make money when you know where it's going? Yeah. If Bob has got $25 million worth of US dollar to sell and he needs to buy yen with it, which way's the US dollar yen going while Bob's executing all those orders? If that guy over there on the speculative desk knows what Bob's got to do this morning, how easy is it to make money? Why do banks never lose? Because they move the bloody thing, don't they? This is why we follow their orders. They bought it there. They bought it there. Yeah. They bought it there. We know they're buying it from there, there, and there. So the sellers are going to come and test these areas to see if the buyers are going to buy it again. That's why we have propulsion gaps. All you need to know is where they've been. You can't tell where they're going. You can't tell when they're going to do it. You can't tell when they're going to start. You can't tell when they're going to stop. But we know where they've been. And they always go back to where they've been. Yeah. If we know where they've been, we know where they're going. That's all you need to know. Simple as that. Realistically, sitting around 50% of drawdown isn't crazy. It is crazy. Well, I think it's crazy. But if you don't think it's crazy, fine. Everybody's different, aren't they? I'm not used to 50% of drawdown. I think I'm going to struggle with this. I really do. I'm doing it because I can't deny the results. I've tested it thoroughly before. And the reason I set the test up was because I tested it thoroughly across multiple instruments on multiple years, and it just worked. So I thought, screw it, we'll stick it up and we'll test it, forward test it for a few months and see if it works. That few months turned into 9, and that 9 months turned into 140% return. The only reason I forward tested it was because the back tests were so good. And that's the only reason I've stuck some money into it this year, because the back tests were great, the forward tests are great. But I'm not comfortable with that amount of drawdown at all. It's out of my comfort zone. But you got to push yourself out of your comfort zone at some point. So that's what I'm doing. Have you got set TPs to exit index shorts? Yeah. So the SIHEA has TPs at 5R. So when the SIHEA gets hedged, it automatically adjusts all TPs to 5R. So when I get hedged, I then look at where it's put the TPs and I adjust them if I think they need adjusting. So watch this on the DAX. The FTSE's screamed through the gap. In fact, that's really the gap fill there. So we're at gap fill on both of these, basically. So I just adjust the TPs. So when it hits that TP, it exits those shorts, and then it will look for an aggressive exit on a bullish move to get out of that move fast on a bounce. This is a lovely sell because there's a very high probability of a bounce off this. We got full 15 minutes until this candle closes, this hourly candle. But it's starting to retrace now at 3R and 4R. So we're very close. But these are the decisions, like I was saying earlier to Brian. This is very close to where I've said it, right? You'd be very annoyed if that happened now. However, if you now exit those shorts, you'll be even more annoyed if it does that. I don't know what it's going to do next, but I do know that that gap's now complete. So this is where we closed yesterday on the DAX. That's exactly there. This is where we closed yesterday on the FTSE. Yeah. So if that was a gap fill play this morning to even the books and balance the books from the overnight guys that got caught out on the gap, they are done. That move is complete. So now that is the next logical move to pull back on that leg. And then we'll see if we've got a sell or a buy bias. So right now is a good potentially spot to get out, but it is or it isn't. Don't forget, if you get out of your shorts here, what are you doing? Trying to stand in front of a steam train. That thing's coming down hard. Who's to say that that isn't going to do the opposite to that? Tricky one. It's a very, 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 very tricky one today. Out of the SIH with $196. Good for you. I circumvented the problem with large orders by setting a fixed lot size. This is also faster. Oh, right. Okay. Yeah. You're the person that had a problem with the order size. Yeah. Fixed lots are better to execute faster because it hasn't got to do the stop loss calculation. So it is faster execution because it skips all the stop loss calculations it's got to do. So, which is why I have the fixed lot in there. DD is account volatility. It's all relative. So if you've got 50% account volatility and 10% yearly return, then it's no good. But if 50% drawdown and 150% return makes relative sense. See, that thinking you've got there is, it makes sense on what you've been taught, but it doesn't. Who said, right, you have to have more return than you draw down on your account? What makes you think that? I agree that is a much better thing to have. But who told you that? Who came up with risk reward having to be a positive? What is wrong with risking 1R to make 0.5R? If I could make 0.5R a day by risking 1R, I'd be happy with that. What about making 0.25R a day and risking 1R? Who told you that you've got to make 1.25R if you're going to risk 1? It's a fallacy. It's just, you know, it's who came up with that? Why can't I press the short button there, going to draw down by 6%, and when it moves back, take 2% profit? I do it every single week. Yeah. What do you see on my P&L? 2% drawdown. I've only made 1.91% gain this month. Yeah. So I've gone into 1.2% drawdown on that pound yen trade. When that pound yen trade comes back down to here and sits at 1%, I'll close it out because it's 1% gain on my account. Look at my drawdown. Because that's hit 1.2% doesn't mean I've now got to make 2.4%. It means I've got to get out with a profit. I understand the thinking, but why are you thinking, if I go into 50% drawdown on my account, I have to return more than 50% a year? Right? If you've got $1 million account and you draw down into it by 200K, right? And you end up the year with 1.1 million, would you be happy with 100 grand? You've used 200K of your account and you've made $100,000. Does that make you happy or sad? Obviously, you'd be happier making 200. That's only a 1-to-1 risk reward ratio. This thinking of you've got to make more than you risk, wrong. You've got to make money. How you make it and how you use your business balance is up to you. I open a shop on a high street. I've got £100,000 to spend. I spend £50,000 fitting my shop out. My shop is going to make 25 grand profit a year. Why has it got to make more than 50 grand? It hasn't. Businesses don't work that way. Businesses make profit. How much of their revenue they use to make profit doesn't come into the equation. I need to make X% return on my account. I don't have to use less of my account to make more of my account. Backward thinking. Anton said it. Anton has said things like, yeah, I get where Anton's thing is coming from as well. But I also know that hedge funds and pension funds will go into very large drawdown on the fund, waiting for assets to gain momentum, stocks to move, things to change. Yeah. Right. Nobody's ever said you can't use more than X to make Y. Yeah. Pension funds don't do that. Pension funds need to return you 5 to 7, 10% a year. Yeah. They won't just use 2% of the 150 billion to make that. They will use as much as they need to make that investment work. It's totally backward thinking. But the reason I think everybody thinks that way is because every trading course on the planet you will get that uses a stop loss says you get in here, you go long, you set your TP there, and you set your stop loss there at 1R and your TP at 1.5. Why does it have to be there, sir? Well, because it has to be bigger than your risk. Because if you do this, you only need a strike rate of 50%. This is not in your control. The entire thinking behind risk reward is flawed because it assumes that you can control your strike rate. The banks control your strike rate. You have no control over that. So why base your entire business model on something that is totally out of your control? It's like getting into a plane and saying to the guy before you take off, fuel my plane up. Decide how much you're going to put in. Thank you. I'm just about to take off. I'm on my way to Antarctica. Got enough? No. Rubbish. It's just totally backward thinking when you think about it. Yeah. I'm using my account to make money. I don't know how much of my account I've got to use because I don't know how far this is going to push before it comes to the point where I can extract the cash. I know why we do it, because we're taught, aren't we? You're taught to use risk reward because everybody is taught that the focus of trading should be achieving a strike rate which gives you a positive R. No, your job is to make alpha. Your job is to make money. Your job isn't to go, I got that exit perfect. My risk was only 1 and I got 5R out of it. I don't care how many R you got out of it. How much money did you make? Only 0.1% because I had a tiny risk on. Well, that's rubbish trade, isn't it? Nothing to do with how good the risk reward is. If you go short here now on the pound yen and you put your stop loss there and you need a 3R, let's measure it. You need a 3R on this trade right now. Yeah. Price has to get, price has to get here. Yeah. So if you go short with a stop loss there now, price has to get there for you to make 3R on it. What do you think price is going to do when it gets there and there? Previous support, respected, broke, retested, broke. What do you think it's going to do when it gets here? Bounce. At either that level or that level. I can guarantee with 90% probability it will at least bounce. When that bounces, what will you do? Go, holy crap, it's not going to get to my target. And you will close it out at what? Less than 1R. Then it will go up there, right? You didn't make money on this trade because your strategy said, I need 3R. The strategy revolves around a 3R strike rate and a 33% strike rate and a 3R return on every trade. The market can't achieve it because it's got too much resistance that it's got to get through and the structure is long. The whole premise of when I do that and that, I have to get there is reliant on the market having to achieve a level which is very, very unlikely to get hit. Because for that to happen, we have to have a strong yen, not happening at the moment. Yeah. And we have to have all the buyers that slam through this level not being in the market anymore after they've been bullish and made a load of money. Not likely to happen. Yeah. Doesn't work, does it? But that's what we're told to do. So you go in, you get in, and then you're told, well, if you get into a trade short and you can't see the market get into 3R, don't take that trade. Well, then what trades do you take? How often do you think you can get there? Well, I know what I can do. It's easy, isn't it? What I'll do is instead of using my stop loss where it is at the moment, I'll reduce my stop loss all the way down to there. Now I can get a 3R return down here. As the market does an M pattern reversal and stops you out before it goes and hits your target and then bounces off with your 3R. Doesn't work. Can't look at it in a this is what has to happen perspective. You have to take the money out of the market when the market gives you the opportunity. You don't wait for the market to get to where you've asked it to get to, because you can't control this. It's not in your control. You just take the money when it's available. When this gets to my average here, dependent on how this has gone and this is going, I might just close it out and go, I'm out. Where's the risk reward? There isn't any. I'm out because I've done very well with the other positions. I've managed to bank 3.5%, and there's a good chance this is going to bounce. So I won't take any money on this trade. It's a 0 to 0R. And I've been sitting in the thing for 2 weeks to achieve a 0 to 0R. That's trading. It's not about using, and I've used 1.2% of my account to make 0. Hasn't got to be positive. Hasn't got to be positive. This has got to be positive at the end of the year, and you do that by hook or crook on any means possible. This is something you need to control, but you can only control it by either extracting some of it or getting in with larger positions and hoping you've got that entry right. You can't control what that is, because if this thing now rallies for a month, I cannot stop this going up. This is where you say I use a stop loss, but then all you would do is get stopped out and get stopped out and get stopped out, because you're still wrong. If you get stopped out 5 times with 1%, you are minus 5R. If you get into this trade now, you need 5R just to get to break even. The losing battle. You can't look at it in that way. It doesn't work. Long term, on paper, again, everything, I keep saying this, don't I, at the moment? I don't know why, but on paper, everything works. Everything works. Compounding works. Risk reward works. I've even got a risk reward calculator on my website. It teaches you about risk reward. Yeah? But it is there not to show you, it's there to prove a point. Yeah? Risk reward will work if the market gives you the strike rate that you require. Whatever that strike rate is. This will help you work out what your strike rate needs to be. Backtest your strategy. Has it in the past worked more than X% of the time? If yes, great. Will it do in the future? No one knows that. But I get the thinking, and in an ideal world, that's exactly what you want to happen, isn't it? But in the real world, you shouldn't be looking at it in that respect. Because with this one, you need to, with the stock index hedge, because the whole edge of this strategy is momentum. And we are looking basically to risk a hedge like that and get a reward at that level. And this is proven to break out and work more than it doesn't. But it will not produce a fortune. It will produce an amount of money over the long term. But this is going into $261 worth of drawdown, or it will just get shut out as loss. So in this respect, your drawdown on your account may well go higher than your monthly return. If you have 5 days on the trot that lose, and then you only get back to 600 return, what have you done? Returned 600. That's great. What did you take as drawdown? A lot more than that. But that's not because of any reason than the banks decided they wanted a whipsaw for 5 days of this month. I couldn't do anything about that. It's not in my control. Just a different method, just different way of thinking of how this thing pays you. You don't get paid monthly, daily, weekly. You get paid over a period of a year, and you won't get paid the same amount each month. Time to shave and go to work. Off he goes. Thanks for subscribing, Vutuan. Welcome aboard. It's not so much risk reward. It's more the volatility of your account balance versus the return. Ideally, you want as high return with as low volatility as possible. Yeah. I mean, you do. And this is what drawdown control is all about. We can control this. This is the thing with trading. This is why I made the "You Are Not in Control" video, which is and this is why on the in the handbook, it's the first thing I get you to watch. I get you to read the 5 steps to becoming profitable, and then I get you to watch the "You Are Not in Control" video, because you have to. It's the basis of everything in this game is understanding that you cannot make a decision knowing what is going to happen. You have no control over the market. The only thing you can do as a trader is control this. You can control your risk, the amount of money you lose. That, in my opinion, is ridiculous. If you control the amount of money you lose, why not make it bigger? Not smaller, bigger. Because you want to give this thing time to move around. This thing needs to go like that over 3 days. People are doing that bit wrong. We know that. The other thing you can do is control this. You can't control that or how long that takes. You can't control where it's going. You have no clue. The only thing in your control is your drawdown. That you can control with drawdown control. We have a mechanism for controlling drawdown, but we do not control how far price goes. We do not control how much money we make. We can control when we close it, and that determines how much we make. And that is the discretionary part of trading, knowing when to close a position. I don't know when to close a position. I know when things have a higher probability of happening, but whether they will happen or not, I don't know. That's where I'd like price to get to. If it gets there, fantastic. If it doesn't, depending on what's happened here and here, that decision will be made there as to what I do. Discretion. Because I can control this. I can make that 0 by waiting for it to achieve that line. When that line is achieved, I can do the drawdown control. 1.22 is my max drawdown. I'm getting out of that position with 0. That is me doing drawdown control, not allowing my drawdown to go higher because I think that might happen. The Japanese could come out this afternoon and say interest rates are going up on the 23rd. We'll be down here. I'll be out there, depending on whether or not I've heard the news live or I'm out walking the dog. If I've heard the news live, I will move my TP down to here. If I'm out walking the dog, I will achieve that. The market's decided that, not me. Not in control. It's true. That's the bit everybody needs to accept. You cannot control anything in this job apart from your risk and drawdown. Everything else is just going to happen. All the RR garbage is from the so-called trading gurus on YouTube, especially ITC. It's from everybody that sells a course. But this is the thing, and this is the difference between what I do and what everybody else does, I think. It's not I'm any cleverer than everybody else. I looked for years at what everybody else did, and none of it worked, right? But I see banks making money. Yeah. Banks, institutions, hedge funds, pension funds, corporate desks, prop firms, I see them all making money. So what I decided to do was stop looking at what everybody else was doing that was losing money and look at what they're doing. How are they making money? They're manipulating price. Well, I can't do that. So what can I do? Mimic what they do. What do? They DCA. Watch the Bloomberg channel. Yeah, you'll hear every institutional trader that comes on there and gets interviewed talking about dollar cost averaging, scaling in and out of moves. Where do you think oil's going? Well, we think it's going up to there at some point in the next quarter. Brilliant. What's your position at the moment? At the moment, we're around about there. Yeah. How many positions you got on? 25,000. Which levels are they at? Oh, they're all over the place, but the average is there because we think it's going up. That's what the banks and institutions do. Yeah. They don't get in with $25,000 short and go, if it goes above 22.5, I'm going to stop out with $25,000 loss. You get shot and sacked immediately and you'd be out on the streets. All I did was look at what they do. Mimic that. How do they move the market? By sheer volume of orders. I can't do that. So I'll wait for them to do it. When they've done it, what do? Make money. How do they make money? By getting out of that. It's all you got to do. Follow them. But we don't know where they're going. We have no control over that. We can just see where they've been. That's all we've got, isn't it? Really, that's literally it. You've got a chart with historical data. It's like looking at 2024, right? Who in their right mind in 2020 looked at this and went, this year we're going to have a pandemic and we're going to shut the economy of the UK down, right? What's going to happen in 2024? No clue. How could you possibly predict where price is going? Yeah. If the Japanese open their mouth this afternoon, this thing's coming down like a rocket or going up like a rocket. I don't know. Depends what they say, doesn't it? Words are very powerful in this industry, aren't they? But yeah, everybody that sells you something is trying to sell you a mechanical edge that's easy to execute, that has a positive return. Because at the end of the day, you want to make money. Yeah. If somebody came to you and said, I've got this fantastic strategy, right? You give me 100 grand, right? At some point in the year, I will have chucked 50 grand of that away, but I'll give you back 20 grand next year. Everyone will be like, So I give you 100 grand, right? You lose half of it, and then hopefully you get me 20% of it back. Nah, not interested. That's what everyone else is doing that's making money. But if I tried to sell you that as a course, you wouldn't buy it. That's why we get told that we can produce higher returns than our risks with a certainty of X%. That sounds great. Try it. Solid points. This made my morning better, I swear. Brian really needs to do a Lee out of context video. I'm going to Antarctica. Yeah. Yeah. I'm going to Antarctica. God, can you imagine? I've got like 3 years worth of content you could clip out to make a video of me. Somebody did one, didn't they? Who was it? I can't remember who it was. I think somebody put a video together of Donald Trump singing Over the Rainbow or something, because over the many, many, many years of footage of Donald Trump, he said all the words for Over the Rainbow. So you can make him sing Over the Rainbow or something. I can't remember what it was. It's something like that. But yeah. I'm going to Antarctica with ICT to see Brian Cox. It's boring. Nothing's working today. Still in that. So I will be getting out of this if we get to target. Otherwise, it's a loss today, I think. Thoughts about the NASDAQ 168.96. You got a sell entry at one. On NASDAQ. Oh, yeah, NASDAQ. I don't know. We'll look at the NASDAQ this afternoon. There's no point putting a sell entry in the NASDAQ now. Why would you? Why? Wait for the momentum. Wait for the market to open and see where it goes. Afternoon, morning, evening, Astro. What's your opinion on retail sentiment and COT data? COT data is no good for daily. So COT data is good for long-term view, where the market is positioned. So this basically tells you where the market is positioned. That's interesting. Look, 73% of the market are short on the yen at the moment. But that's your bird's eye view. Retail sentiment is very good short-term intraday. But short-term intraday is really sort of for scalping. So you want to be going long on the Swiss yen, because 91% of the market is shorting it. Funnily enough, that is one of the yens that isn't coming down, is it? But combine for me, the power of sentiment is the combination of the two. So if you pick which way the banks and institutions are positioned and wait for retail to go the other side of it, that gives you a strong signal to go the other way. Yeah. So if the banks are all long the euro and short the yen, that gives you a high probability of euro yen strength. If retail are all short that pair, the banks are more likely to rally because retail gets it wrong. So that for me is the power in it, is using the combined sentiment to decide on direction if you want to use that. And the reason I don't use it is because I just don't use it. There's 1,000 ways to make money out of this market. This is one of them. I don't use it. I could use it, but I don't. I use other things. There's no right or wrong. That will fail sometimes and it will work sometimes. But most of the time, look at the pound odd. So the pound odd at the moment, you should be longing it. It works, but it can't be used as a timing tool. Yeah, this is where it's no use. Yeah, all sentiment is absolutely useless for timing. So what you should use this for, in my opinion, is you wake up in the morning, you look at the charts, and you wait to see if price gets to a good support and resistance level, i.e. pushing the opposite direction to this. So the pound odd, everybody says the market is shorting it at the moment. Yeah. So retail are short, which means you want to long it, and the banks are long it, right? So wait for price to pull back, and the banks are likely to long it again. And all the retail guys, when that starts to come down, they're all going to pile in short. So all the liquidity from retail is going to be sitting at the top. Not that that makes any difference because the banks don't use that liquidity because most of their positions are over the counter, as I said. This is where, again, this whole stop loss theory falls flat on its ass. The banks don't even know retail exists. Yeah, if everybody in this room now and everybody in the broker of everybody in this room, 25,000 people or whatever, all of us were short at the same time on the same instrument, the banks couldn't use our stop losses to execute an order because their orders are 100 times larger than everything we would put into the market. If we all pressed the short button at the same time, it wouldn't even tick because the banks would just go, yep, I'll have that. Yeah. Stop run is the most ridiculous theory in the universe. Retail stops are there, so the banks will move the market there to take the retail liquidity. They don't even know it exists. Barclays have just done 150 million transaction with HSBC. It didn't even tick on the chart. Nothing to do with it. But sells courses, doesn't it? Same as the interbank price delivery algorithm. Come up with something that nobody's ever heard of, they'll buy it because it's new. AI, get on the bandwagon. What's your opinion on? I just answered that one. Thoughts on the NASDAQ? Yeah, I don't know, Algo. I don't trade the NASDAQ in the morning. NASDAQ is a US instrument. Starts at 2:30. Don't trade it in the day. Trade it this afternoon. I'll be trading it at 2:20 this afternoon. So this afternoon, I've got a doctor's appointment at 3:40. So I will be doing 2:20 as usual for the afternoon session. We'll analyze what's gone on with CPI, see how that's happened, see how that's affected the market. And then I will probably trade the open, but I've got to go to the doctors. So I will be leaving about 3:10 or something. So I'll be knocking it on the head about 3. So I'm only going to do half an hour session this afternoon. But we'll go through the FX pairs. We'll go through the news. We'll obviously see what's happened here. And we'll look at the open, see how the open goes. Hopefully the open will just be explosive and everything will hit target within 15, 20 minutes, which is we get those lovely days, which would be nice. So that's the plan for this afternoon. And then back same time tomorrow. So tomorrow morning, if you're not coming to this afternoon's live room, you need to be aware we've got GDP before the open tomorrow for the pound. So the FTSE will likely get a spike pre-market. So we may well have a little bit of a liquidity issue on the FTSE in the morning, because obviously that's an hour before the market opens. But we'll see what impact it has. If the GDP comes out as expected, we probably won't get a lot of movement. And to be honest, at the moment, GDP is the last thing that traders are looking at, because it's a byproduct of inflation and interest rates. So it's it is a leading indicator, because they usually make decisions based on interest on GDP. But at the moment, they're much more interested in inflation. So it's very hit and miss, GDP. So we'll see. But that is tomorrow morning before the live room. So be aware of that. If you've got any pound pairs on, you might have a decent opportunity for profit taking or scaling in tomorrow on that. And obviously this afternoon, it's all about the US dollar. But as we can see, there's nothing moving so far today. ADRs are flat. RSIs on the hourly are flat. We're waiting for CPI. So I will wait and see what happens with these. Hopefully we get a little bit more of a push down and I can get out of these on a retracement. But other than that, bit of a dead duck this morning. All right, so have a good morning. I will be back this afternoon, 2:20, and tomorrow morning, 7:50, same time as usual. If I'm not, I will be in Telegram if you need me as well. But other than that, have a good morning. I'll see you next time.